Hi, everyone. Thanks for joining us. We're going to give it about 1 or 2 more minutes for other folks to join in, and then we'll go ahead and get started. Okay. In the interest of time, we're going to go ahead and get started now. Thank you, everyone, for joining us. We're happy to see you. My name is Lindsay Monina, and I'm an advisor at Knightsbridge. If it's been a while or you haven't met us, we're an independent registered investment advisor, and we manage $800 million on behalf of our clients. We offer investment management as well as financial and tax planning services, and it's in that tax planning capacity that we're talking to you all today. So this webinar is an online version of an event we did recently that got great feedback, so we wanted to make it available to a wider audience. And the plan for today is that we will be walking you through 9 strategies at a high level. After we talk about each strategy, we're going to be pausing for Q&A. So please feel free to submit any questions you have as we go through the Q&A function on the bottom of your screen. If we don't have a chance to answer your question live today, we will be happy to follow up with you via email. So thanks so much. I'm going to turn the call over to our first speaker, Kurt Beinfor.
Thank you, Lindsay. As Lindsay mentioned, I'm Kurt Beinfor. I am a principal here at Knightsbridge Wealth Management. Thank you again for joining us today. Our plan here is to share a number of strategies which you can use to potentially save yourselves millions of dollars on taxes. Our goal over the next hour here is to make you aware of the strategies that are available to you and understand which ones potentially apply to you in your specific situation. So as we talk here today, to provide context, we're going to follow the journey of Darren and Cindy. Darren and Cindy's path may look familiar to some of you. Maybe you're at one of these points in your own personal journey right now. From my perspective, Darren and Cindy's path looks a lot like the American dream: buying a home, starting a business, sending kids to college, investing in real estate, getting involved in philanthropy, selling a business, and then ultimately disposing of real estate when you hit a point where you're tired of property management. And Darren and Cindy, as you can see here, each of these events, was a point in time in their lives that presented an opportunity where there was potentially some liquidity created, some wealth created, and some tax associated with that wealth creation. And ultimately, they were left with a fraction of the money that they earned throughout their working and investing careers. So for each tax saving technique that we discuss here today, we're going to tie it back to Darren and Cindy's journey and show how with the right planning, they could have saved a lot more of their hard-earned dollars along the way. So as I mentioned, we're going to walk through several strategies, 9 in total. Each strategy is going to check one of 2 boxes, and a couple will actually check both of these boxes. And you can think of these boxes as really, our core tax mitigation principles here this afternoon. The first is on the left-hand side here, you see moving assets to a tax-advantaged location. So when I say tax-advantaged location, you're probably familiar with some examples like a 401k or an IRA. Those are examples of locations where you're operating in a tax-deferred environment, or a Roth IRA, a tax-free environment. All those would be tax advantaged locations, but there are others, and we want to make sure that you're aware of those. And as you can see here, investing in a tax advantaged location can have significant impact in amplifying your investment returns over a period of time. So you see the example here, a portfolio that earns 9% a year in interest income. If you're someone who's a high income California resident, you're looking at 1.5 times the size of portfolio after a 10-year period, and after 30 years, you're up to about 3.5x what you'd have versus what you would have investing in a taxable environment. Our second tax mitigation principle for the day is avoiding capital gains taxes altogether by positioning yourself such that you never have to sell. And so what does that do? That enables you to, we're going to share some strategies where you can still diversify and generate liquidity from the asset, and the next generation still would receive that step up in basis. So as I mentioned, we're going to discuss 9 strategies here today. We're going to start out basic and then increase the sophistication as we move along. We've attempted to align our speakers and their sophistication with those strategies. So starting very basic with yours truly, and then we will move on to my partner and the founder of Knightsbridge, John Pritchard, and then lastly, Miles Yorman, who's both a principal and portfolio manager here at Knightsbridge, will take us home. So with that, the first strategy that I'd like to discuss here today is 529 plans. So when Darren and Cindy sent their kids to college, what did they do? Well, they funded tuition with their after-tax dollars that were sitting in their bank account. What could they have done? Well, instead, they could have used a 529 plan account. And what that would have enabled them to do is really fund college with a lot less of their hard-earned dollars. 529 plans are probably the most simplistic and straightforward tax planning strategy out there. Anyone can do it. You don't need to have a large liquidity event to open a 529 plan account. So we encourage everyone to take advantage. So this strategy checks our first box, right? We're moving assets to a tax advantaged location. In this case, a tax-free location. 529 plan accounts function mechanically similar to a Roth IRA. You are contributing after-tax dollars to an investment account. Those dollars grow tax-free, and then so long as the funds are distributed, when they're distributed or spent on qualified education expenses, they come out tax-free as well. And so, the gift tax loan, these are a contribution to a 529 plan is viewed as a gift. The gift tax exemption limit is $18,000 annually. That's $36,000 for a couple. Now, there's a trick here where you are allowed to super fund, and that is the term, super fund a 529 plan by front loading 5 years worth of contributions on day one. So if you're talking about $36,000 for a married couple, now you're looking at $180,000 that can be funded on day one. And so, for clients who have a liquidity event, it's common that we will see them take a portion of that. You put $100,000 in a 529 plan, and then boom, done. College is paid for, and you don't have to think about it again, because those dollars again are compounding for up to 18 years tax-free, which is really powerful. So big ideas here: putting college savings in a tax-advantaged location. You can contribute big dollars early and have college expenses taken care of. Should also mention these are very flexible. You can change the beneficiary very easily, and you can also, with the Secure Act 2.0, there's now a release valve if you've overfunded or don't use all of the funds, if the beneficiary does not, where you can roll up to $35,000 over to a Roth IRA. So this is a fit really for anyone with kids or grandkids, or and the financial ability to plan ahead.
So Kurt, we have a question from an audience member. What kind of funds can you invest in inside of a 529 account?
Yeah, that's a great question. Typically, we recommend clients go direct. Don't go through an advisor. There's really not much value that an advisor can add on these types of accounts. So you're better off going direct. It's lower cost. Vanguard, Schwab, Fidelity, these are all great options. They're all very low cost, and they all have index fund options, low cost index funds that you can invest in. So it's similar to a 401k where you log in and there's a menu of investment options, target date funds, although rather than targeting retirement, it's targeting the age that the beneficiary reaches 18. And you just want to focus on building a low cost portfolio. You want to be, growth equity heavy or in the earlier years, and then become more conservative as the beneficiary approaches college age. But the short answer to the question is basically stocks and bonds via low cost index funds.
Great, thanks for that. And then the second question is, how do I disperse these funds when they're needed for college?
Yeah, there's a couple ways. One is you can send the check directly from the 529 plan account to the university. You can also pay the university yourself out of your bank account and then reimburse yourself out of the 529 plan account. So that's another way to do it. There's a window there that you have to reimburse yourself, but it's pretty generous, at least 6 months. Okay. Well, those are all the questions on 529 plans. We'll move on to our second tax mitigation concept, and that revolves around retirement plans. You think about Darren in our example, opening a business. He started a law firm, and what did he do? He put in a 401k, like many business owners do. There's potentially a match, allows employees, participants in the plan to defer some salary. Allowed Darren to do the same as the business owner. He could defer some of his salary. But there's a better mousetrap here, and something that Darren could have done, and that is to have worked with a third-party administrator known as a TPA to structure a retirement plan that would allow the lion's share of the benefit to go to himself, the business owner. And this has really two major benefits. One, would have shielded a greater percentage of his income from income tax, and then those assets would grow tax deferred. So again, this similar to our first strategy, 529 plans, this strategy is really all about moving assets into a tax advantaged location, in this case, a tax deferred location. So as you look at these boxes here, what you see is there's really different building blocks that you can put together, and this is why you want to work with a third-party administrator to customize one of these plans for you and your business. If you're a business owner, you start with the basic salary deferral and employer match, which is the cost of one of these plans, by the way. It isn't, if you provide an employer match, you need to provide that for all of your employees, and that's really a benefit that you're giving to the employee. But then it allows you to layer on other components. So, for example, profit sharing contribution. These can be structured in a way where certain participants, certain employees receive larger profit sharing contributions based on their value to the firm. And that gets you into that. Now you've moved from that $40,000 to $50,000 range to the $70,000 to $80,000 range. But really where this strategy comes alive is by adding a cash balance plan, or some of you may have heard of a defined benefit plan. A cash balance plan is a type of defined benefit plan. And that is effectively, setting up your own personal pension plan. We don't have time to go into all the details today of that strategy. But what I will say is that can allow a business owner to defer up to several $100,000 of his or her compensation. And if you have a spouse in the business, now you're multiplying that times 2, and you're talking about, upwards of, $500,000 that can be put away potentially annually on a tax deferred basis. So really powerful. So the big idea here really is, business owners can change their company's retirement plan to enable themselves to contribute more. Contributions both defer income tax, and most importantly, grow on a tax deferred basis. So this is good for anyone who can, and really everyone can and should contribute to their company sponsor plan. But the real benefit here is for business owners who can implement a plan that is in their favor.
Thanks, Kurt. Our only question for this one is, how big does my business have to be to implement this?
So it's not really about size. Any business can implement one. It does cost a few $1,000s to pay a TPA to set one up. Really, it's about the cash flow of the business, because you're committing, if you're putting into place a cash balance plan, you need to have the cash flow to fund it. And the ability to fund is built on multiple factors: age, profitability of the business. Profit sharing contributions can be discretionary, but if you go into the cash balance or defined benefit plan world, it's typically expected that you're going to be making these contributions for 3 to 5 years. So it tends to be businesses that are steadily profitable and forecast themselves to continue to be profitable for the next 3 to 5 years. Okay, well, with that, move on to the last strategy that I'm going to discuss before we bring out the big guns. So Darren and Cindy are philanthropically inclined. They made regular contributions to causes near and dear to their hearts, and they did so, scratching checks annually from their bank account, like many of us do. But what could they have done? Well, during high income years, they could have contributed to a donor advised fund, a DAF, these are commonly referred to, and that would have enabled them to receive a large charitable tax deduction in those years, and when they really needed it, by essentially pulling future charitable contributions forward into that year. And if they really wanted to take advantage, they could have contributed highly appreciated stock into a donor advised fund as well. So this strategy actually checks both of our boxes today. So first, we'll talk about how you move these assets into a tax advantaged location, in this case, a tax-free location. And we'll also talk about how you can use it to avoid the realization of capital gains. So when you contribute to a donor advised fund, so first I should back up and say, opening a donor advised fund is very easy these days. You can do it through a brokerage firm like a Fidelity or a Schwab. It's very similar to opening just a simple brokerage account. When you contribute to the donor advised fund, that contribution it gives you a charitable deduction, right? So and then the donor advised fund is able to gift to charity over time at the pace that you wish. Those contributions to charity are not the tax deductible event. It's the contribution to the donor advised fund. So what does this allow you to do? Well, let's say you've had a big income year. Maybe you've sold a business and you're sticking on as part of the transition plan in the earnout period at an elevated salary. You really could use those charitable deductions that year. So what can you do? You could put $100,000 in a donor advised fund. Most people aren't comfortable giving $100,000 annually to charity, but you want that $100,000 deduction that year, and then you can pace future contributions out over time. So again, you have the big income year, you really need the charitable deduction because you're in that high marginal bracket. You make that large contribution to the donor advised fund, and then from the donor advised fund annually, you can gift to the charities that you choose at the pace that you wish. And so that's how you're taking advantage of moving assets into a tax-free location. Now, if you really want to take this strategy to the next level, you contribute, rather than contribute, after-tax dollars from your bank account, you contribute highly appreciated stock. So in this case, you can see that Darren and Cindy have $50,000 of Apple stock. They bought it for $20,000. That's their cost basis. They have a $30,000 gain. And so on the left-hand side, you see if they were to sell the stock, they'd pay a little over $7,000 in long-term capital gains. That would net them $42,000, $43,000 that they then can contribute to charity. And then that that contribution would have given them a $15,000, $16,000 charitable deduction, income tax deduction. However, if instead they were to contribute the Apple stock directly into the donor advised fund, they wouldn't pay any capital gains tax. They'd avoid it altogether. They'd now have $50,000 in the donor advised fund, so making a $50,000 charitable contribution rather than a $42,000, $43,000 contribution, which would give them a greater charitable income tax deduction in the amount of about $18,500. So what is the value that's being created here? Well, you created close to $10,000 in tax savings for Darren and Cindy here, $7,000 in long-term capital gains taxes that are no longer need to be paid, and an additional $2,000-$3,000 in income tax deduction from the larger contribution. So that's roughly $10,000 in value created for Darren and Cindy. Also, an additional $7,000-$8,000 in value contributed or created for the charity because they're receiving a larger contribution. So a total value created of $17,000 here just by contributing the highly appreciated stock rather than selling the stock and contributing the proceeds. And so, all dollars are fungible, right? It's not common that we sell a stock to make a charitable contribution, but typically what's happening is they're two separate acts where you're making a charitable contribution out of your bank account, and then later down the road, you're deciding to sell a stock. So we're just coupling the two together here.
Great. There's no questions on this one. So at this time, we're going to switch it over to John.
Thank you, Lindsay. Well, it's nice to be with you today. I'm John Pritchard. I'm going to talk about a couple of tax strategies that move us into the stock market. And the first is personalized indexing, which is a very smart way to invest in the stock market and not only avoid capital gains, but go further and actually capture valuable tax losses while growing your portfolio in the stock market. And if we think about Darren and Cindy, they saved money and invested through exchange traded funds, ETFs, which are great, and we use them. But if they had utilized personalized indexing, they would have been much better prepared for the eventual sale of Darren's law firm because they would have built up some capital losses to apply against that gain. And that's the idea. When you look on the next slide at what we're doing here, we're investing in the stock market, but instead of buying the index, one fund, we buy all 500 stocks or close to that to deliver the same return that of the index and see the portfolio grow over time. But in buying the individual stocks, we then have many more opportunities to harvest losses as the stock market inevitably fluctuates. And we monitor the portfolio in real time all day. And as you can see on this slide, when some of the originally purchased stocks end up declining, such as in this case, Chevron or Coca-Cola or General Motors, they are liquidated to capture the loss and replaced with comparable companies to continue to replicate or deliver the indexed return. So it's a great way to achieve growth in the stock market while also capturing valuable losses, which can be utilized in the current year or carried forward in preparation for a future gain. And so really, I think this is a great strategy, can be very foundational for anyone who wants growth in their portfolio because the stock market can be very rewarding over time, and anyone that wants to reduce their capital gains either now or in the future. And so the big idea here is that on this next slide here, Darren and Cindy, if they had taken $3 million after 5 years investing, earning 10% per year, that $3 million portfolio would have grown to 4.4 million. But in harvesting losses each year, the cumulative loss would have been over $600,000. And actually, for any of you that can meet a $3 million minimum and are going to have a large liquidity event, we call it supercharge this strategy at the $3 million level and run a more aggressive or effective loss harvesting strategy. And that's the light blue arrows that actually, after a few years, the value of the cumulative realized losses exceed the starting $3 million portfolio value. So it's a way to really cut down your capital gains if you know you're going to sell a business or a residence or something like that, if you have a year or two head start and some capital that you want to invest in the stock market. Another way that we use this strategy, if any of you have a highly appreciated stock position, your Apple or Nvidia stock, at the beginning of a calendar year, as you see on the slide, early in the year, that position has contributed to the strategy, and 40% or so of the stock is sold the first day, because the entire calendar year remains to harvest losses through the year and diversify that starting stock portfolio position. And then the first day of the second year, another 36% gets sold. And so in a year and a day, the majority of this concentrated, maybe risky position has been diversified. And by the end of the second year, the tax-free entire liquidation has occurred. So it's a great way to deal with a concentrated stock position by matching it off with loss harvesting. And so this is something we implement in our portfolios, and it's the advancement of technology and the elimination of trading commissions has made this possible. And I think it's a bright future as far as an optimal way to invest in the stock market. And I'll stop there and see if there are any questions on personalized indexing.
Well, John, you preempted our question, which is, this seems so beneficial. Why isn't everybody doing this?
Yeah, we use some sophisticated software, and I think it took the computer power and the elimination of the commissions to really enable this. And some smart investors figured these strategies out.
Yeah, and also I'll add to that, Lindsay. I think one of the reasons that more people aren't taking advantage of this is it's relatively new, and people are just learning about it. You know, it kind of reminds me of when we had the ETF boom, where people were, took people a while to move on from, mutual funds to ETFs, and to understand the benefits of passive investing and capturing a market return with low fees as opposed to expensive mutual funds. This is kind of that next wave where it's, hey, you can get that indexed return with these additional tax benefits that you can't get in an S&P 500 ETF. So you can still capture that same return, but you can harvest all these additional losses while you're at it.
Good point. And a lot of these strategies we will explain today pair well with each other. So the personalized index portfolio, a lot of the remaining positions will become highly appreciated over time, and they make great candidates for the donor advised fund that Kurt explained. So where we can, we'll pair different strategies together.
Not to mention, some of the later strategies we'll talk about, which involve deferring capital gains realization, pairing with this to buy some time. We do have a second question. What value of concentrated stock is worth using this strategy for? What amount?
Any amount, really. The degree of appreciation, I'd say, is the governing factor. So generally, when something's 100% appreciated or more, it certainly would be nice to avoid the capital gains tax. So we can build this strategy for really any situation.
And what I would say is, typically the portfolio needs to be $1 million, but many times the appreciated position is maybe a couple $100,000, and it's a component of the portfolio, and then other positions or cash is added to meet that minimum.
Yes, and we've implemented this, as Kurt alluded to, with cash as a starting portfolio, and also transitioning an existing portfolio tax efficiently. We can do it either way. Turning now to the next strategy. Oh, sorry, go ahead, Lindsay.
No, I was going to say exactly the same thing. You read my mind.
Good. The next idea is something called an exchange fund, and it's a way to diversify from a single concentrated appreciated stock position into a diversified portfolio without paying any taxes. And so Darren and Cindy, she received a lot of incentive compensation, one specific stock, and then she would sell it and pay the taxes. If she had utilized an exchange fund, she could have ended up in the same place, diversifying without incurring capital gains, as I'll explain in a minute, the feature benefit of an exchange fund. And so it's a way to de-risk a portfolio through diversification tax efficiently, as the next slide will will show us. So the use of an exchange fund would be good for anyone who feels their portfolio is too exposed to a certain stock or small number of stocks, and 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 wanting to avoid obviously incurring the tax. You can use these exchange funds, and the way it works is you contribute your stock to the fund, and a variety of shareholders of different companies are doing the same thing to enable the fund to create a diversified portfolio of which you own a pro rata share. So you get an interest in the fund that the returns now becomes equivalent to all of the stocks inside that fund. So think of it as, instead of selling your stock, buying the S&P 500, you're exchanging your stock into what is equivalent to an S&P 500 index. There are a few funds out there that do this. We can guide you to them. They have to want your stock. They have to be open to take in new stocks. But it's a great way to compound your returns on a pre-tax basis, as the next slide indicates. So if Cindy had a $5 million stock position that was highly appreciated, if she sold it, she'd be investing just over $3 million. Whereas keeping all $5 million invested in the stock market, after 7 years, she has roughly $3 million more. And maybe in the meantime, she's been running the personalized index strategy to build up losses that would enable her after a while to go ahead and liquidate the exchange fund. Or perhaps she just holds the exchange fund and someday her kids inherit it tax-free after a step up in basis. So it's another pathway to tax efficient diversification. Any questions?
No questions on this one, John. Go ahead.
Okay. Turning now to real estate, and similar to an exchange fund, but for appreciated real estate that's non-owner occupied, so income properties, rentals, we can utilize something called a Delaware statutory trust. So in Darren and Cindy's case, they had their duplex. They enjoyed collecting the rent, but eventually Cindy tired of dealing with renters. And so they sold and paid the tax. Because they liked real estate, they ended up buying real estate funds on it with after-tax money, utilizing a DST, a Delaware statutory trust, and through a 1031 exchange code in the IRS regs, they could have avoided the tax. And that's the way the Delaware statutory trust works. So this would be a good strategy for anyone with appreciated real estate where they'd like to transition from active management of an income property to a professionally managed diversified real estate portfolio without incurring tax. And the process is to sell the property. You go ahead and sell, and then within 6 months, you take the proceeds and invest them in one of these DSTs. And there are a variety of them out there. We can guide you to institutional quality DSTs. That Delaware statutory trust will own real estate, and you will continue to collect income and see appreciation just on a passive basis. And then after 2 years, the IRS allows you to do a second exchange, going from the DST into a real estate investment trust, achieving further diversification, again, on a tax-free basis. And so at the end of the day, you end up with a passive portfolio continuing to collect your income and see your appreciation. And you can actually withdraw your basis from the original property once you're in that real estate investment trust. So it's a very tax efficient way to transition your real estate from active to passive. Any questions on that?
Not a question. Hi, this is Miles Yorman. I'm a principal at Knightsbridge, but I really wanted to emphasize the last thing John said is once you go into a Delaware statutory trust, you can keep doing those. They typically have a finite life, or you can 1031 back into real estate. But if you go into the REIT option, it's very hands-off. You don't have to do anything, and you can actually get your tax basis back. So you can sell a certain number of the shares, and it's just like getting your basis back. You don't have to realize any gains on those. So you can free up some of your capital to invest elsewhere without paying any tax at all. But that brings us to our next real estate focused strategy, which is opportunity zone funds. So if you remember Darren and Cindy, at the beginning of their journey, they bought a house, but they wanted to downside eventually. So they sold the house, paid all the taxes, started renting. And because they were renting, they had extra money. So they invested it in what they knew, real estate. And then 10 years later, they sold that real estate investment and paid tax again. So they could have done all of this, just what I explained, with way less tax by using their sale proceeds to invest in an opportunity zone fund. And I'll just say that the sale of any appreciated asset, you can invest those gains into an opportunity zone fund. It doesn't have to be a real estate asset like in Bob and Cindy's case. So this strategy is about, the main thing that this strategy is about avoiding paying taxes on that second investment. So this is a little bit different from our other strategies, because if you've had a big gain, this is something you do with your money after the gain, although I guess that's similar to a DST, though it's best to plan it out before. Okay, so what does it do? It does a couple things. It delays capital gains taxes on the original investment, and then it completely avoids it on the second investment. So you defer the investment on your already realized gains, and that's only until 2026. It's been 2026 since this was created by the Tax Cuts and Jobs Act. So now obviously 2026 is a lot closer. That first advantage is not as good as it used to be. But this is an area to watch, because now with Trump being reelected, there's some speculation that this program, which was broadly popular, might get reauthorized. Okay, so you've sold your appreciated asset. The capital gains tax that you would have had to pay gets delayed until 2026. You take your gains and you invest them into one of these funds, and then the fund will invest it into real estate development in a specific area. Like there's one in Westside Costa Mesa if you're local to Orange County, where we are. You'll get tax advantaged income from a real estate investment, as many of them do, along the way. And then the really big thing is that ground up real estate development investment you make, 10 years later, when that's sold, you pay no taxes whatsoever. And for the real estate pros out there, that includes no depreciation recapture. So like I said earlier, it's not quite as good as it used to be, because you're only deferring that initial gain until 2026, but it could get reauthorized. So who is this strategy good for? Somebody with a big liquidity event in their future who likes the idea of investing in a real estate project for 10 years. So there's limited liquidity. It's not for everybody. It also might be interesting to people who are doing some estate tax planning, because if you make this investment and then either if you gift it away or it becomes part of your estate, it usually gets valued a lot lower than the actual value, because there's illiquidity and minority owned interest discount. So it can be useful for estate tax purposes. Okay, are there any questions before I move on to our next strategy?
Yes, could you just clarify what the reauthorization of the program would mean for the payment of that first capital gain?
So we'd have to see what Congress decides to do, but if they were basically going to do the same thing over again, they would pass a new law, and then if you had your big gain and invested it in a new opportunity zone fund, the tax bill would potentially be delayed until 2020 or 2036. And so you're delaying that original bill for a long time. And I'll also add that because the bill does need to get paid, usually what happens, you're investing in a real estate project, they get it up and running, they get it leased up, and then they do a bit of a recap and they send you out money to pay for the taxes. So you don't have to come out of pocket from your other investments to pay those capital gains taxes that are deferred.
Yeah, and one thing I'll add there, Miles, is, when this was initially passed through the Tax Cuts and Jobs Act, or came out in 2018, the first Opportunity Zone funds launched in 2019. So there were a couple benefits at that time. You actually received an immediate income tax deduction, which subsequently phased out. So we could see that come back. And then the tax was deferred to 2026, as Miles mentioned, your 2026 tax bill due April of 27. Well, in 2019, that was a really lengthy deferral. So you think about the time value of money to be able to defer that tax bill for 7 years. 7, 8 years really powerful. So again, yeah, this is reauthorized. I would expect that you'd be able to defer that tax again for another 7, 8 years, and you have to stay in the project for 10 years. And so the ability to defer the game for 7 and then 3 years later you're out, that's really attractive.
And Kurt, just to hit on that point you just made, we have a second question. Are the taxes only wiped out if you're in the opportunity zone for 10 full years?
Yes, you are locked in for 10 years on these investments.
To get
We
the
have
full
another
benefits,
question.
yeah.
Correct.
Are there funds that do opportunity zone funds? Or do you have to buy and manage the real estate directly in the designated areas?
You can actually do either. So it's really about a
But we don't
designated
recommend it.
Right. It's actually, you have to invest in a designated opportunity zone, and there's specifics around this, but you have to improve the area substantially. And so the funds that we partner with are institutional grade, and they are involved in ground up development. Could be, a multifamily apartment building, could be, build for rent, but ground up development that's substantially improving the area. So if you go do it on your own, it's quite a bit to take on, because you're typically going into a blighted area, though not always, and you're tearing something, buying something, tearing it down, and then improving it.
So we'd recommend doing this through a fund, and we've looked at a number of them and have ones that we like.
Great. That's all our questions for opportunity zone funds right now. We'll move on to the next one, Miles.
Okay, so our next strategy is a charitable remainder trust. And this type of strategy involves both of our big ideas for tonight: moving assets into a tax advantaged location and avoiding the realization of capital gains. Okay, so what happened with Darren and Cindy? The law firm wasn't worth anything when they started it, but by the time he sold it, it was really valuable. And the government took a big bite out of that valuation in taxes when he sold it. Darren reinvested the proceeds, and eventually he gives some of that money to charity because he's a great guy. With a little planning and foresight, Darren could have put all or part of his business ownership into a charitable remainder trust before he started the sale process. Then when he eventually sold the business, he could have avoided gains on the eventual sale. The reinvested proceeds inside that trust would have grown tax-free, and we talked at the beginning how powerful that can be. And eventually Darren gets more cash distributed to him out of the charitable remainder trust than he did from doing things the normal way. And then at the end of the trust's life, his favored charity would get a huge donation, way more than he could afford under what actually happened. So moving to the next slide, the big idea here is through a charitable remainder trust is that you, the donor, probably end up with more money eventually, but your designated charity ends up with a lot more money and the government ends up with less, and that appeals to a lot of people. So I apologize if I repeat myself just a little bit here, because it's a little bit complex and I want to make sure you get the basics. Unfortunately, I'm going to have to gloss over the details, but we can talk to you about those later if anybody's interested. So here's how it works. You gift appreciated assets like stocks or a private business. In Darren's case, it was an interest in the law firm, to a charitable remainder trust. Then the charitable remainder trust sells those assets. And because the charitable remainder trust is like a charity, it sells those tax-free and it reinvests the proceeds tax-free. Then the CRT pays you a specified amount or a percentage of the total amount each year until the end of the term of the trust, which can be 10 years or 20 years, or you can have one that lasts for the term of your life. Those distributions are taxed when they come out. Whatever is left at the end of the life of the trust, that goes to charity. And that's why it's called a charitable remainder trust, because the charity gets what's remained. So again, the benefits are, and I think I skipped one of these before, is You gift the appreciated assets, and you actually get to take a tax deduction in year one, though it's not for the whole value. It depends on the specifics of the trust. So you get that tax deduction. The trust sells the asset without paying taxes, which can be really meaningful. The trust gets to reinvest those assets tax-free, so they grow faster. And this results in more money to you over time as you take your periodic distributions from the CRT. And then the charity gets the balance at the end, and the government gets way less. So going to the next slide, we've shown an illustration here, which has a lot of assumptions, but I'm not going to focus on those assumptions or the numbers, just the shape of these curves, because they give the general idea. So if you sell your appreciated asset and pay you do have to pay the taxes, but you'll have a big pot of money, which is the gray line in this case. You start out with more money, but then as you reinvest it, you're paying taxes along the way. So that's like a ball and chain on your returns. It grows slower. The blue line represents what a charitable remainder trust does. You do have some value on day one from your tax deduction. That's 600,023 in this example. But then it grows faster because it's growing tax-free. And this shows the combined amount of money that you have after paying taxes, and it pays distribution. So by the time you get to the end, you've got a modest amount of more money, but there's going to be a huge amount that you can donate to your charity. So who is this good for? It's good for people with highly appreciated assets, people who are interested in a steady income stream, who are charitably inclined, and who are not likely to change their mind halfway through, because once you're in this, you're committed. You can't say, oh, I decided I wanted to buy a couple mansions. No, you're kind of reliant on your distribution stream. And it's good for people who are willing to tolerate a significant amount of complexity, because this is not a straightforward process.
And I'll add to that, Miles, if you don't
Sure.
mind me jumping in.
Please.
Just that what we commonly see with these is this is what we see clients do either when it's their second liquidity event, or they do it with a portion of a large liquidity event. These typically don't make sense if you do less than $2 million to start, because you got to pay an attorney to draft one, and then it has its own tax ID and files its own tax return. Secondly, as you can see, you're giving up a lot of liquidity here, really with the goal of shifting funds from the IRS, the government, to your favorite charity. And so, this is more common. We don't see this with people who have, one liquidity event and they put the entire asset inside the charitable remainder trust. It's either a portion or it's their second liquidity event, and they're happy to just take a steady income stream rather than that lump sum.
We've got two questions. So the first of which is the distribution rate dependent on the type of CRT chosen?
It is dependent. So there's three types of CRTs. There's a 10-year, which is the shortest term. It has the highest distribution rate, and over the long run, it has the least cumulative benefit. There's a 20-year, longer term, and that has its own distribution rate. And then there's something called a lifetime. The 10-year and the 20-year, you have a beneficiary who, if something happens to you and you pass away before the end of the term, they take over and they receive the income, and then the funds are distributed at the end of the term. If it's a lifetime and it's just a single life, then it ends when you pass away and all the funds are distributed to charity. You can also do a lifetime on 2 lives, in which case it's a second to die, a second to pass. So whoever passes, or excuse me, it's based on the younger of the 2 lives. So, and that's how that works. Then it is second to pass. The distribution rate is based on the younger life, and then it's the second to pass is when it distributes to charity. So, yeah, and then the distribution rate is also, it resets quarterly. There's IRS tables that dictate that rate. So it's the type of CRT and then the IRS tables.
You preempted our second question, but I want to highlight it anyway in case there's any further detail you want to add, is that can you donate to the charity during the term of the charitable remainder trust, or is it all at the
I'll take this one. Yeah, once you've signed up for this thing and the money's in, you can't say, oh, I actually want to donate the money now, even though the trust isn't finished. The money gets donated at the end of the trust. Of course, you can always decide what to do with the distributions it throws off. You can send those over to the charity, but you're sort of locked into what you agree to.
Excellent. Well, we'll move on to our last strategy. So Miles, go ahead with private placement life insurance.
Okay, so this one is my personal favorite, and I know you've all been very attentive in this. Tax strategies can perhaps be a little bit boring, but pay attention if you want to learn how to invest and pay no taxes like the ultra wealthy. So Darren and Cindy, they've sold a lot of assets. They had a lot of cash. They invested this cash into taxable investments like stocks and bonds. They could have made these exact same investments inside a PPLI, private placement life insurance vehicle, and had a lot more money and left a bigger legacy to their children. So insurance is in the name, but this strategy is all about moving assets to a tax-free location where they can grow quickly. It's kind of like being able to create a giant Roth IRA where you can put a ton of assets that quickly grow tax-free. Unlike a Roth IRA, however, it doesn't unlock when you retire, and that can be both good and bad. But also unlike an Roth IRA, which is definitely good, is that you can get cheap, tax-free access to the value inside this insurance vehicle. So a little disclaimer, like all of our strategies here, in the interest of time, we have to gloss over some details to make this manageable. So this isn't exactly a liquidity strategy, but it's one to think about after your big exit. And technically it's insurance, but we work to make sure it's as little like regular insurance as possible. And by the way, we are a fee-only advisor. We don't charge insurance commissions. So if we were to do this, we'd introduce you to a specialized broker who can help do these things. So instead of insurance, I like to think of it as a tax-free box into which you place assets. So you get your money into the box by paying insurance premiums for a couple years, and then you start to see the benefits. So you might say you'd pay $3 million in premiums over 5 years. So what are the benefits once you get your money inside the box? The first is that your money grows tax-free. And we talked about in the beginning how powerful that can be under our assumptions, 3.5 times as much money over 30 years. That's a really big deal. Then what's really nice here is that your advisor can invest it however you like. And so for people with a lot of assets, you're probably employing different strategies. Some of them are maybe high tax, like private credit. You move your private credit allocation from a taxable environment to this PPLI tax-free environment, and it's going to return twice as much if you're in some of those highest brackets. And your advisor can have a lot of flexibility. And then another benefit, and this is key, is that you can borrow from this insurance policy at low cost. And there's no tax implications to this. So you put money in, it's grown a lot, and then you think, okay, well, I don't want it all to go to my heirs. I want to buy a house or something. You can take a loan from your own insurance policy. And sure, you're going to pay interest on this, but you're paying interest to yourself, to that policy. It goes there. The insurance company only takes a really small spread, something like 0.25%. And so there are some fees, but generally they'll be less than 1%. And so you're going to save way more on taxes than you'll really pay in fees.
Miles, I'd like to add one other piece,
yeah, go ahead,
if you don't mind. And that is many of the attendees today may be familiar with whole life insurance or universal life insurance, which are forms of permanent insurance that are often sold and positioned as supplemental retirement policies. Conceptually, this is really identical, very similar, but there's a key difference, and that is with whole life insurance, you receive, accrediting from the insurance company each year that tends to mimic the investment grade bond market with the return, the yield that you get, which is a much lower return than you get elsewhere. And when you have something like universal variable life insurance, you're captive to a menu of investments like a 401k. Many of those are high fee. They're typically just traditional stocks and bonds. What private placement life insurance allows, or PPLI, is that same tax-free environment where you can borrow against the cash value tax-free, but within that policy, you can now invest with full flexibility, like Miles said, in things like private credit, certain real estate deals if you want to go into. So it's very powerful from the standpoint of investment flexibility within the policy.
Thanks, Kurt. As I was saying, so this is how the super rich really avoid taxes. We've been trying to convey the best tax strategy is to never sell anything, never realize any gains. And so when you need cash, you just borrow against the value of it. Continuing with the benefits of PPLI, when you die, all that money goes to your heirs' estate tax-free if you set it up right, which of course we would do. So it's a great estate tax planning strategy. And on that note, the initial contributions into the PPLI box do not count against your lifetime gift exclusion. So taking a breath here, the big idea is that after a big payday, this is a great place to put 20% of your portfolio and have it grow tax-free. Create that generational wealth for the next generation. Who is it good for? Well, first, you need $1 to $3 million to start with. So unfortunately, you already have to be rich. Secondly, you have to be into long-term planning and be willing to deal with some significant complexity. Thirdly, you have to be happy leaving some money to your heirs. You can't borrow the whole value back out. And fourth, it's great for people who want to plan around the estate tax. So I'm probably not going to stop for a question because I do want to wrap this up before the hour in case people have to leave. Tying it back to our journey of Darren and Cindy, we see that at every step they had, if they had known about some of these techniques, they could have saved a lot of money. When he started the law firm, he could have designed a retirement plan that allowed him to shelter a lot more of his income from taxes and get it into that tax advantage location. When they saved for college, they could have done it within a 529 plan and effectively put less away, allowed it to grow faster to pay for college more easily. When they donated to charity, they could have given a highly appreciated stock directly into their DAF, and then from the DAF to the charity, instead of selling the stock, paying taxes, and contributing cash. Then, before their big liquidity event, as they were investing, they could have gotten the same return as ETFs, but used personalized indexing and also accumulated taxable losses, which they could have offset when he finally did sell the law firm. Although speaking of which, if he had put part of his interest into a charitable remainder trust, then when he sold the law firm, no taxes would have been paid, and though it could have grown a lot and he could have ended up with more money and definitely a lot more money for a charity. After that big liquidity event, they could have planned for the future by putting a portion of their assets into the tax-free environment, which is private placement life insurance. And then finally, when they were disposing of their real estate assets, they could have avoided taxes or diversifying them by putting them into a DST, a Delaware statutory trust, or an opportunity zone fund. And
Thank you,
yeah, we're at our hour. We can take some time to answer questions, but I'll let Kurt finish up.
Yeah, thank you. So, today we focused on the high-level benefits of these 9 strategies. If you suspect that one of these may be a fit for you in your situation, you're of course going to want to learn more about that specific strategy. Best way to do so would just be to contact us, book a meeting. For the tech savvy, you can use that QR code, and that will, if you hover your phone over that, you'd be able to pull up a link that will allow you to book a meeting with us directly, or you can just use the contact information in the lower right-hand corner of your screen. So please don't hesitate to reach out with any questions. And thank you again for joining us today.
And for those curious, we are happy to distribute the slides we walked through today, so you'll be receiving those via email after we wrap up.
Before we get into any questions, I'll mention one more strategy that we didn't talk about today, which is qualified small business stock. And so that's for somebody who's founded a business and really, and who plans to sell it. If you think you're going to sell, you can only take advantage of this this strategy where you get a huge portion of your sale proceeds tax-free if it's a C corporation. So if you have a business that's an LLC or a partnership and you plan to sell it in the future, you're going to want to think about converting that to a C corp at some point when you sell, so you pay a lot less taxes.
And only certain industries are eligible, which we can explain to you if that fits. Thanks for your time, everyone.
If there's any other questions, please feel free to stay on the line, but at this time, we have concluded our prepared portion. Thanks everyone again for attending. It doesn't look like we are getting any questions in the Q&A, but please feel free, like everyone said, to submit any specific questions via email, and we're happy to answer those. Have a great rest of your day, everyone. We're going to conclude now. Thanks.
Thanks, everyone.
Bye-bye.